Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. After that, we will be taking a brief tour through our core list of companies, and if you stick with me towards the end of the video, I've got 3 additional trade ideas to share with you, so definitely stay tuned for that. A quick update on our t-shirts. They're set to hit production in about a week or so. We're supporting a local business. We're getting them made right here in town at the print shop, which is great, and I'll let you know as soon as the order link is available. I also fully understand that the video is coming out fairly late tonight. If you know the keyword, drop it down below in the comments section. Let's rally the late night crew and dive right into today's analysis. So, kicking things off with our S&P sectors as we always do. Who was leading, who was losing, and where was the weight? The XLU for the utility sector led the pack today, up 1.04%, whereas down at the bottom of the barrel, we see the XLE for the energy sector down 1.71%. Both of these sectors are defensive in nature and also lightweight, so to really look at the distribution, let's just focus on the 3 heaviest weighted sectors. So, top dog is going to be XLK, that's the tech sector, heaviest of them all, up 0.86% on today's session. The XLF is the second heaviest weighted sector that we're watching. That was actually down 0.25% on today's session. And then we have the XLV, third heaviest weight in our lineup, second by market cap technically. That was up here towards the top of the list, up 0.67% on the day's session. So 2 of the 3 heavy weighted sectors are actually distributed towards the top of the list, giving us a little bit more confidence in the up moves that we saw on today's session. Let's dive into the structural charts though and really pick apart what's going on with trends and our levels. So zooming in on our XLU, big reversal on a failed breakout of the bull flag. So this look right here on the Tuesday session. This is actually a good thing for the market. We do not want to see this defensive asset class leading the charge to the upside for the potential of an S&P 500 bottom, right? So this coming in here, consolidating back within the flag range is actually a decent look. So no concerns in the XLU. The XLK, the heaviest weighted sector of them all, perhaps the most important sector. Let's spend some time and break down this chart. Really important recapture of this level right here. This number is 128.40 and it needs to hold into the remainder of the week. The reason I say needs to hold is because if we look just below us here, if it were to break down, we have a weak level on the chart. The reason I classify this as weak is because we have 3 back-to-back equal lows. If the market were to revisit that area, we would expect that support to break down, and that would send us here, thus preserving the daily downtrend by forming an equal low and again giving us here a lower high. So the XLK really needs to hold that 128.40 into the remainder of the week. It can be sideways and put in bullish consolidation, that's fine, or it can get some more lift higher, and that would start to put into play a higher low double bottom, right? Obviously, it doesn't technically trigger officially, so to speak, until we break the neckline of the pattern, which is here, the bottom of the gap at 134.36, but overall, that would be a bullish positive look for the S&P 500 and the XLK, the tech sector overall, which I would imagine would correlate quite nicely with the QQQ. So just to keep it simple here, we want to see the double bottom if we're looking for a major market reversal. If we fail 128.40, look out below. I do imagine that on any subsequent tests, 125 breaks down and preserves the daily downtrend, bringing us for an equal low closer to that 122. So really important to watch this into the remainder of the week. The line in the sand, if you want to keep it simple, is 128.40. We want to stay above that. Next up, we've got the XLV, the healthcare sector. What's happening here? Another heavy-weighted sector, as we know, second by market cap, so let's spend some time on it. We're back inside of this month-long balance. This was a look below and fail. Technically speaking, on the higher time frames, we should be looking to target the top end of the balance. That's how a look below and fail works, essentially. And currently, you can see that we are remaining in nice consolidation from a bull flag. If we talk about this, though, I want to bring up exactly what we just mentioned in the XLK. Notice how we had all of these equal lows. 1, 2, 3, 4 back-to-back equal lows, maybe even 5 if you want to count that one in there. Look at what happened on the Tuesday session, right? We snap down underneath them, clean up the stop losses, collect liquidity, whatever you want to call it, and then look at the close on the Tuesday session. Strong up at the highs of that bar, firmly back within the flag consolidation. So we repair this poor structure. The sellers do not find follow through back down into the bottom end of the monthly range. And on today's session, we consolidate in the upper half of the bull flag. To me, that's really impressive buying activity, and the rotation in healthcare still seems to be alive and well, being the second heaviest weighted sector. We're watching for the break up and over 130 to really get us here into 133.50. That would be the bullish look and be what really probably propels the S&P 500 higher if we get the breakout into the remainder of the week. So really liking what we're seeing here. The nice to hold would be 127 at this point. The needs to hold is 125. Of course, the bottom of that monthly balance that we just saw. Next up, we've got the XLB materials. We're not going to spend too much time here. Obviously, a really lightweight sector. If we zoom in a little bit further, we do have a nice bottoming setup. 2 back-to-back hammer candles taking out the hammer highs should trigger a move here. That would kind of be the double bottom neckline. But remember, even if that were to happen, if we were to get this lift into this area, it's not going to do a whole lot to save the day if the XLK fails at its critical level, if the XLV breaks back down underneath 125, right? If this lifts here, it's such a lightweight sector, it's not going to save the day. So sure, would it be nice to have, market participation in materials? Absolutely. But if everything else is sort of falling apart, don't look at this as a saving grace. The same thing will hold true for the XLI. This is industrial. The look here is slightly better because we have the higher low double bottom instead of the lower low double bottom, and the move would be into the neckline here close to that 89.50-ish handle. Back-to-back hammers are about the same. Remember, lightweight sector, even if it does make this move, it would just be nice to have extra, broader market participation, but we still need that follow through in the XLK and the XLV and the XLF, most importantly, that we'll see in just a moment here for the S&P 500s to continue higher. If this stuffs and just kind of goes sideways, it's really just a neutral indication for the marketplace. Next up, we've got the XLP. This is consumer staples, right? And this is a defensive sector by nature, and I'm really not that concerned with the fake breakout on today's session. The reason I call this a fake breakout is you can clearly see the inverted hammer highs breach the highs of the flag consolidation, and then we close back down within the flag. So the fact that this didn't get follow through is not overly concerning because we know it's a defensive sector. We want to see it remain fine sideways in this flag, and once XLV breaks out, the XLK sort of gets some more firm acceptance over that number, that 128.40 we were just discussing, maybe it moves to the neckline, then this one can play catch up, and that would be a better look for a market bottom here. So again, not overly concerned with the action we saw in today's session, the fake break. No concerns here in the XLP. Just want to see it kind of remain sideways and then catch up eventually. Next up, XLC, communications. What's happening here? This is a heavier weighted sector. It's definitely more risk on than the XLP, that's for sure. And we are starting to see a little bit of a double bottom look, but the critical difference here is the fact that this is still underneath this set of support, which was then resistance here, right, for the lower high, and we haven't cleared it yet. So overall, a lot of work to be done. This still looks to me more like bear flag consolidation in this overall zone. Sure, you could start to say higher low double bottom, but remember, you still need to breach the neckline, which is technically 57. That 56.40 level is still going to be fairly important as well, right? That was our prior support from in here. So some work to be done. Don't get me wrong, the consolidation bar from today's session strikes me as, decent or at least healthy. It's not as bearish as it could possibly be. I would really break it down and just, simplify it like this. In here, a little bit more neutral, right? We're outside of this multi-day balance, and we're also respecting the consolidation in the upper half of the green breakout bar from Tuesday's session. If we were to break out, that's a little bit more bullish, recapturing this prior support, which is then flipped resistance, right? So that's 56.40. And then if we were to break back down underneath 55, that's not a good look, right? To me, that would just be high, lower high, probably coming in for the equal low here, which again, just like we were talking about in the XLK, would preserve the daily downtrend, right, with the equal low and lower high. So next up, we've got the real estate sector, lightweight sector, not going to spend too much time, just look at it like this. We're building out blocks higher. Is the next one going to be overhead? Maybe, kind of just sideways in consolidation right here. It's such a lightweight sector, again, that it's not going to save the day or impact the market too much if it breaks down from here or breaks out from here. I would just look for it to continue to go sideways, inverted hammer off the top of the range, not really that bullish of a look. Next up, we've got the XLF. This is where we should spend some time because it's the major laggard, and we'll see that on the ratio grid in just a second. But just like the XLC, here's prior support, then flipped resistance. Notice how far away we are from that level. That's 32.50, just to give you a nice round number. This did not get in gear on the Tuesday breakout or any follow through on today's session as we got outside of the 2-day range, right? Technically, that upper wick was scratching at the top end there, and there was no follow through from the buyers in the financial sector. So to me, this is where the work needs to be done. If financials want to pick up the slack and sort of do something like this, at least recapture 32.50, that would be a really really, really positive look for the marketplace, noting we've already seen improvements in the other two heavyweighted sectors. If financials are going to continue to lag, I think it's going to be what prevents the market from really seeing, significant follow through on any sort of up moves. I mean, to me, this is still stuck in bear flag consolidation. It's underneath that critical zone. It's really not that impressive. It's not helping the case for a better and more firm bottom in the S&P 500. Overall, again, I would really focus on the fact that we're still underneath this level, but you could make the slight argument that we have this sort of support trend line going on. But again, just holding support at such a gradual pace isn't going to help the market find, any follow through on breakouts up and over daily ranges that we'll talk about on the SPY in just a moment. So XLF really needs to prove it to us and show us that it wants to get up and over 3250. That would be a primary watch into the end of the week. Do we get back above, or do we come into it, stuff, and then roll back over? That would be really not a good look, noting that we would have high, lower high, lower high, right? That would set up the move for lower and really confirm that this is no more than bear flag consolidation. So XLF is the one that needs to pick up the slack. Next up, we'll take a look at the XLY consumer discretionary. What's happening in this one? This one never broke down underneath these lows firmly, right? And you can see we're getting a little bit of lift here. We're still underneath the first dead cat bounce high, which is going to be that 143.14. Notice that we just consolidate here. I would say it's healthy consolidation. We're well outside of the 3-day range from here, which is a better look. It's more bullish than bearish, that's for sure. But if this is going to trigger as a daily double bottom, a higher low double bottom, that's fine. We know the neckline needs to be in play, and we need to make a new higher high up and over 148.25. If it's going to be a weekly double bottom, right, something that would look like this, obviously it's got to be up and over this neckline, which would be 157.18. So still some work to be done here in the XLY. It's a heavier weighted sector, definitely top 5, not top 3. So we're going to, we dove into it a little bit here, but we do want to see this continue to improve here and not drift back down towards these lows. If it does, obviously you just have something that looks like this, descending triangle. This would be susceptible to breakdown around 136. So it's really got to break this trend line. It's got to get up to its neckline around 148.25 to start feeling a little bit better about the consumer discretionary sector. Last but not least, the energy sector. What's going on in this one? You can clearly see there's our 100% retracement, dead cat bounce, equal low, so sets up the H pattern, bear flag, whatever you want to call it. We did start to see a little bit of follow through. Remember this. Downward pressure is still downward pressure for the S&P 500. Yeah, we didn't want energy leading the charge up here, but we should start to want to see this thing find a footing, right? So is it going to be at the green line? That's the 200 SMA here. Is it going to be at this horizontal support close to the 66 mark? I don't entirely know, but I would like to start to see this go sideways instead of just collapsing and continuing to fall off of a cliff and giving back all of the gains that it saw on this massive rally since the beginning of the year. So energy, it is, again, decent look, not leading the pack to the upside, but we do want to start to see it find a footing instead of just continue to break down underneath 66. That's been the structure charts for our sectors. Let's take a look at the ratio grid now. The top 4 are, of course, our risk on sectors. Now, what's going on up here? You can see the XLK is still in a descending triangle, but it is approaching the top end of the range as opposed to threatening breakdown at the bottom. So a sign of slight improvement, but it's definitely not out of the woods yet. The XLV continues to look absolutely fantastic on this push higher. Good distance between it and the gold line, which is the 50 SMA. And by the way, if you don't know what this chart is and you don't know how to set it up, here's a tutorial video for you in the top right-hand corner. But nonetheless, continuing along, the next 2 in the risk on sectors, the top 4, are the XLY, which is continuing to just go sideways here. It strikes me as an okay look, but we really want to see it perk up higher and start to improve and not just be so neutral, right? If the market's going to find a bottom, it needs some broader participation through all of the risk on sectors. And then lastly, the XLF. As we saw with the actual structural chart, it doesn't look good. It hasn't recaptured that 3250 level that we were just discussing, and the ratio grid would also confirm it's kind of stuck in this descending triangle. And unlike what we saw in the XLK, this is not at the resistance portion of the trend line. It's threatening the breakdown, right? So risk on is currently not triggered. The only thing that really looks great here is the XLV currently. XLK could start to perk up, but again, 1 of 4 is not enough to turn risk on, and down at the very bottom, our bottom 4 are, of course, the risk off sectors. What do we see here? XLP looks fine, continuing to trend upwards over a upward sloping 50 SMA, the gold line, right? So that's currently a risk off look. Energy pulling back aggressively. That's a decent look to start to turn off risk off. But again, 1 of 4 is not enough. You can see that the XLU utilities are still above a nice upward sloping 50 SMA, and the real estate sector is kind of just going sideways, really kind of more neutral, kind of just barely above a flat 50 SMA. So risk off is not turned off and risk on is not turned on, but there are some signs of improvement with our XLK approaching the top end as opposed to being down here towards the bottom end of its descending triangle. That's the main takeaway from our ratio grid. We need better participation in our risk on sectors if the market's going to start to see any sort of follow through to the upside. Let's get on over to the TNX. This, of course, is our 10-year interest rate. What's going on in this one? So again, further pullback off of these highs, which is a good thing for the tech sector. We really want to see the XLK take advantage of this and kick into gear. As long as we're kind of in this box right around here, so hovering between 3.1 and 2.7 on the 10-year, I would say that's a comfortable spot for the XLK. If it starts to perk back up and do something like this, obviously that's downward pressure for the XLK, which is downward pressure for the S&P 500. And I don't really think that 27 or the 2.7 mark wants to be breached to the downside. But if that were to happen, of course, I do imagine the XLK responds quite favorably to that type of condition. Again, probably not a favored outcome of this current chart, especially in these market and economic conditions, but that would be the sort of expectation if for some reason it were to be breached. Next up, we have the VIX. What's going on with volatility? If we take a look, we're still in the box of wickedness, as we've been pointing out for quite some time. Is this going to start to act as a flush point? Maybe. If the market starts to see some follow through up and over some of these highs, which we'll discuss in just a moment here, we really want to see this perk back down. Maybe perk back down isn't the right sort of wording there. Breakdown, I suppose, would be the proper sort of wording. But nonetheless, back to business. If we were to get under 25, that's where I would start to say, okay, we're clearly getting out of this box of wickedness. Maybe this is starting to become a little bit more of a firm footing as a bottom in the S&P 500. As long as we're in this box, which we've just outlined, I think it's still on the table that we could head lower, right? There's still no reason to believe that we, could not head lower, right? So I suppose I worded that the wrong way, but you get the gist, right? The next thing I would point out from a volatility perspective is the VVIX. And once again, I sort of bring this up just to reiterate that no one's hedged right now. So if there is going to be a massive breakdown, it's going to come hot and heavy because the VVIX is so low. No one's buying VIX calls. No one's buying SPY puts. That's what this is sort of indicating here. So if everyone's rushing to the floodgates all at once, it should cause a nasty downside reaction. That's exactly what we saw here, right? That's when that big breakdown happened essentially, and it could happen again, noting how far underneath that 103 handle we are in the VVIX. All right, let's get into the S&P 500 finally and talk about tradable levels into the upcoming week. So we did actually breach our highs of the multi-day balance, right? So we were essentially going sideways for 4 days. We took out the highs and we went to the blue target that we discussed in the pre-market live stream. Now the close here is the concerning part, not the fact that we went to target, right? So we pulled back aggressively from the level, which still would indicate that there's the possibility for nothing more than a lower high here on the daily time frame currently, right? I would start to think of this as a higher set of lows. So that to me is sort of interesting, but we're not quite out of the woods yet until we can get more firm price acceptance over the blue line. And just to reiterate where the blue line is even coming from, if you're not familiar with it, here's the really sharp rally, consolidation above, right? As we breach it to the downside, that's where all hell is let loose on that prior Tuesday session. So notice, big aggressive pullback off of it. To me, overhead supply sold directly at the level. It's not a coincidence that that's exactly where the market pulled back from in the afternoon session. So that needs to be breached. In the short term, on this 30-minute chart, yeah, things do look good. We have, nice strong rally, flag, a little bit of consolidation, right? And now another push higher. Is this going to turn into another higher low and then reattempt? If we were to do that off of a higher low here, from here to here, essentially on the 30-minute, that to me would set up a breakout to get up towards the top edge of the weekly expected move and also that daily resistance area around 390, right? So that would be the bullish look into the remainder of the week. If this is going to act as the true rejection, we're probably going to do something like this. That sets up the head and shoulders, right? Boom, there you go. Your breakdown point is somewhere in here, or more conservatively, just underneath 378.72 again. You can see that on the daily time frame. Resistance, support, right? And then we chopped through it kind of in here. You saw that on the 30-minute as well. But if we were to break down through that, back down towards the bottom end of the weekly expected move and the lows here, which again, just like the XLK, are all fairly equal. If we were to move back down into this, that does set up the flush point for a move into the equal low here, again, preserving the daily downtrend. So that's my major concern with many of these charts right now, is the fact that these lows are, technically weak. And if they were to be breached, we do set up the downtrend continuation here on our daily time frame. So that's what I have for you on the SPY and the 30-minute. Again, I think that the primary look into the remainder of the week should be to see if we get follow through from this type of activity right here. Probably looking for the 386 retest, and if we can break it, it's game on to the upside into the remainder of the week. That's what I'm watching out for, but again, willing to adjust on the fly if we get something that looks like this, that then breaks down underneath this prior support, flipped resistance, and that would bring us back down closer to the bottom edge of the weekly expected move. So that's the SPY in a nutshell. Let's take a quick look here at our market internals. What's going on here? This is going to be the dead giveaway on why we haven't been getting follow through this week. Also, top right-hand corner, if you don't know what this screen is, this is going to show you how to set it up, what it all means, how it'll help you make better intraday trading decisions. This is the main takeaway of why we're not getting any follow through over the trading week, right? So if you looked at this morning's open, it wanted to break out up and over this level. It simply didn't do it. We had that 4-day balance high there. It struggled with it all morning. Why was that? Because the volume flows for the entire week have been out of the market, not in the market. The breadth was never really positive enough to really get us up and out of range. The same thing is true with the advanced decliner. Although it was improving steadily on Tuesday, it really wasn't positive, right? It was negative the entire day, and it fell immediately back to negative early on in the session on today's session. So to me, these are the reasons we're not seeing follow through. The same thing with the tick. Notice that early on, it's really failing at the zero line. Look at the cumulative build here on the Wednesday session. It was fairly negative, fairly early in the session. So to me, this is why things aren't adding up. This is why the market's not really getting in gear when we're crossing these breakout points. So to me, the pullbacks are where you want to be looking for buy entries as we're coming into support. Now, you want to make sure your internals are turning at least as we're coming into that, or the context is at least improving. This was definitely wishy-washy because of the FOMC volatility, but I would say if internals are continuing to be lackluster, try to buy supports in this new budding uptrend instead of looking for the breakouts, because follow-through has been really, really hard to come across in these current market environments. So that has been the internals. Let's take a quick peek at the market profile. Again, if you don't know what it is, here's a video for you in the top right-hand corner. All I want to point out on this one is that yes, value did shift higher from Tuesday to Tuesday to Wednesday. I was about to say Thursday, one step ahead of myself. But look at where the point of control was left on today's session, right? So you can clearly see it was lower instead of higher, not really confirming the breakout to the upside. Now, was the breakout there? Yeah, it was there, but the volume that transacted wasn't really significant enough to move the point of control higher. You can see more people were willing to transact here as opposed to here as that breakout over the 4-day balance actually unfolded. So that is a slightly bearish indication, or at least a neutral, I would say, leaving the point of control lower in the profile distribution. Back on over to the platform, let's round out the broad market here with our QQQ. We'll go back on up to the daily time frame. Then we'll do the core list, 3 trade ideas. We'll send you on your way. All right, in the QQQ, what's going on? So higher low, interacting with the resistance trend line. It's do or die time in the QQQ. It needs to break this here off of the higher low. That's what we've been waiting for. That's what we've been watching. If you're watching early on today's session, so let's actually go back to the 30-minute time frame. So here we go. Another reason the SPY could not get in gear. Right, the Qs were just rejecting cleanly at the resistance trend line from the daily time frame. So as long as that's happening, your SPY is probably not going to get in gear, right? If we go back on over to the daily, again, a retest off of a higher low on like the intraday 30-minute time frame of the blue line should set up the move into the gap again, and that's going to be really where the next up move is delivered from. Can we get above the higher low double bottom neckline and also fill the gap overhead? It's essentially the same thing that we just saw in the XLK, but that's going to help out the S&P 500 tremendously if that type of move can unfold. Your line in the sand to the downside is going to be this 284.50. We want to remain above that, at least here for healthy consolidation. Anything that's back down underneath would be a fake break of the trend line, and of course, setting up more of a failed move from the bulls, indicating that on the daily perspective, yeah, if we just scrunch up the chart, obviously the downtrend would remain intact if we just get stuffed once again at the trend line. So again, just to keep it simple, healthy consolidation as long as we go sideways here, looking for breakouts to fill the gap overhead. If the market's going to be bullish, those are the targets that I'm looking for. Next up, we've got the IWM Russell 2000 and the small caps. What's going on in small cap land? A little bit more, I would say, risk off looking, that's for sure. Notice the breakdown into the close here. It closed firmly inside of this prior multi-day balance here instead of above like we saw in the QQQ and even the SPY. It's not as bullish, right? So because of that, this is much more of a risk off indication. You can also see a failed backtest of the support trend line once it was broken here, failed retest. We're rejecting at the blue line as well. Could it put in consolidation and then break in the future? It could, but it's not as bullish as it could have been. I would have liked to see a green close outside of the prior day's high to really have more confidence that maybe the market's moving higher here and that we should expect more of a risk on indication from the IWM. So I suppose neutral to slightly bearish in here, definitely bearish back down underneath 169. And if the blue line were to be breached, look for the equal high up here around 177.60. That would be your like optimally bullish indication into the remainder of the week. All right, core list of companies. What's going on in Apple? Taking a quick peek here, you can see that this chart looks fantastic, and being the heaviest weighted, constituent of the SPY and the Qs really has me feeling more bullish than bearish. Sure, we did pull back a little bit here, but nonetheless, look at the nice rally that we've seen off of this higher low for the already equal high. So because of that, we're either looking for the next higher high or a higher low pullback to unfold, and I do think it can happen up and over this 140 level. If we go on down to the 30-minute time frame, you'll see why. Look at how it was prior support. We flushed it, cleaned up all those equal lows, turn it into a resistance here, we've broken it, and a higher low is formed above on the 30-minute time frame. So I'm thinking as long as consolidation can happen above, or even if we do pull back a little bit more firmly, we last tested it as resistance here for a breakout, I would imagine that it could offer some support, do something like this, and then from there, on the daily time frame, that would of course produce the higher low. Equal high up here sets up the breakout point, so 1, 2, 3 touches classifies our pressure cooker top, short proximity of time. If it breaks the 50 SMA at the same time, even better, right? Two things breaking at once, boom, next target overhead is 148.25. And of course, as we mentioned, being the heaviest weighted component of the S&Ps and the NASDAQ, that would of course bode well for continuation in both of the indexes. Next up, we've got Netflix. What's happening in this one? Really, it's starting to get better at least, but still not impressed. I've talked about why the psychology of this breakdown here was so important. I'm not a little, I just am neutral in this area of the chart. The next trade for me is a breakout up and over these highs, 192.25, to roughly move up towards the top end of the next balance, 202.25. Now, I totally get it. There's a lot of work to be done before that's even in play, but based on this fake breakdown here, or fake breakout, I suppose it would be. This was the fake breakout, confirmed breakdown. I'm just not feeling the love inside of Netflix, especially with this lower wick that we saw put in there. Nasty move as we sort of retraced all of that and then got follow through underneath the support trend line as well. So to me, Netflix is kind of hands off in this zone here. Next trade would be up and over that for me. Probably not even looking for shorts underneath this 183 anymore. I don't know. It would have to be a very obvious intraday setup, I suppose. The daily is not really offering anything clean to the downside. Next up, we've got Tesla. What's going on in Tessie? This one's also been fairly choppy, 100%. Like if you think about this as a range, and we always talk about this on the channel, there's the midpoint of the range. You usually don't have an edge in the midpoint. You have an edge at the edge, right, for a breakout or mean reversion. Same is true, but opposite at the bottom, mean reversion or breakdown. We don't have that in the midpoint. And to see how it just sort of went nowhere as we, broke out of the 3-day balance here. So remember, this is an outside bar on the Tuesday session. We made a new low. The sellers failed to push it lower. Buyers responded and closed outside of the 3-day balance highs. Extremely bullish implication. So the fact that there was no follow through here up and over 700 today, a little bit kind of, skeptical. Like, why was that the case? Why were the buyers not stronger here to at least get us closer to that 736? So that would be the continued look into the remainder of the week, because we certainly have bullish consolidation in the upper half of this Tuesday bar. So I would be leaning on that as, okay, bulls are still kind of in control here, even though we're in the midpoint of the range, looking for that follow through. If we firmly fall back down underneath 690 and we're getting acceptance here, neutral, kind of waiting, being patient for the next setup. Next up, we've got AMD. Getting a little bit of dead cat bounce off the oversold move. So this here was oversold. We talked about the gap and trap essentially on NVIDIA really was the playable one. We'll talk about that in just a second, but it's the same idea inside of AMD. So just watching to see, can we get any further move higher? And the better reshort in AMD is up against 80.44. I will continue to maintain that that is probably the better place to enter a new short here instead of looking for, a new short here, immediately breaking down. So see if we can get a little bit more lift. That would be the preferred entry, and then a rollover from that point. Watching for inverted hammers, right? Intraday double tops, not inverted, but regular head and shoulders. Any of those key reversal patterns at 80.44 start to get interesting on the back test. It would be a break, retest, fail, and then go lower, right? If it's going to turn into upside clearly, inverted head and shoulders, right? Something like that on the daily. Clearly very, very speculative, not really in play at this given point in time. Next up, we've got Meta. What's going on in Facebook? Just a range. Nothing to really do here until we take out the top. Next trade would be over the gap. So between 172.56 fills up to 175 even. If that were to just clear on big momentum, the target overhead through this thin structure would be the breakdown point at 188.50. So that's what I'm watching for to the upside. It would also roughly coincide with the 50 SMA as an overhead target. If it's going to reject here, that's fine. Maybe we can trade back down towards the bottom end of the range, just playing ping pong in the sideways channel, right? So from here to here to here to here, and eventually once we break out, we're looking for any sort of follow through that we can get. I would say volume tapered off on today's session, so light volume on the consolidation. That's actually bullish, right? That's actually bullish. Next up, we have NVIDIA. What's going on here? This is sort of the same trade that we talked about in AMD. Big gap down on the Tuesday session, way oversold. We caught the gap fill, and now we're just kind of consolidating higher. Again, the better reshort entry is 155.50. If we can get here and put in some sort of failure or a rejection of this level, that would be the better time to enter short, looking for a rollover back down to the equal lows, and then seeing if we can get continuation from there. If it wants to put in acceptance above, just like in AMD, that's fine. We might have the potential for an inverted head and shoulders, but patience, right? Very, very speculative as of right now. Doesn't strike me as a likely possibility just yet, or especially into the remainder of the week. Next up, Microsoft. What's going on in this one? Really bullish, kind of more like Apple, I would say, with the equal high already in place, especially after a higher low. Strikes me that even a little bit of follow through to here starts a new daily uptrend, which is fantastic. This is, I don't think it's definitely the top three. I don't know if it's second slot or third slot in terms of weighting in the S&P 500, but a really important individual company for the S&P 500, right? So watch this coming off of the equal high, watching for breakouts, new daily uptrend here, really positive indication for the S&P 500. Again, we do have the higher low in place. Ideally, consolidation wants to remain above 261.60, and your breakout is over 267.25, right? That's what I've got in Microsoft. Again, looking for this type of move on this stock. Next up, we've got Amazon. What's going on in the mini beast here? Last but not least, the mini beast. We certainly have a little bit of resistance coming into play. 50 SMA descending, obviously, and also the potential for a lower high here. This did not create an equal high on today's session like Microsoft. We also have equal lows already in place. If we fail back down underneath 112, that to me sets up the bearish route into 102.61, which is the serious flush point that we've really been eyeballing the past couple of weeks, really, inside of Amazon. So I'm really, really watching this. If we start to roll over here, if we just get consolidation and move higher, that's fine. Obviously I'm not, shorting prematurely for the breakdown of 102.61. It's as simple as that. If the level comes into play, it comes into play. If not, then so be it. We'll just, wait and monitor for the next obvious setup. I'm not really seeing one here to the upside. I suppose consolidation like this would build out a short-term, like hourly bull flag, and if we were to break out, you want to see it hit 120 so we can make a new higher high above that 118 lower high from here to here. That's the core list of companies. Let's get into our three trade ideas now. The first one is going to be on ARKK. Can you believe it or not? The innovation ETF, big pressure cooker top here on the daily time frame. Prior support, then turned resistance, resistance, resistance. Again, low, higher low, a little bit of a pullback candle here. I'm not sure that the breakout happens on tomorrow's session, but if we were to consolidate for a bull flag, something that looks like this on a 30-minute or an hourly chart, let's go there now. So again, something that kind of respects this area here, more pressure and a break up and over 46.25 triggers the daily buy up into, I would say this should be our target around 52.38. So watching how this resolves here, of course it needs to break it on momentum for us to enter the trade, but really watching that level 46.25. Next up, what do we have? We've got BABA, can you believe it or not? Coming back from the dead here, another pressure cooker top on the daily. This one also clearly has a nice support trend line, something that would look like this. You could also call it a pseudo cup and handle. candle, whatever you want to call it. The breakout point is 120.11. Also the 200 SMA here on the daily time frame, call it 120 even, whatever you like. Your next breakout move is into 127.75. Now keep in mind, if you do decide to trade something like this, you're looking at this to happen on the intraday session, because look at how choppy, look at how gappy the stock is still being after it's kind of tried to resolve this bottom, right? So the overnight headline risk is still pretty high, and you want to avoid getting caught up in a gap down if it were to reject off this level. So this is, at least for me, got to be an intraday trade only. There's no overnight hold on something like that inside of Alibaba, but 127, and then monitor for continuation up into probably this next set of highs around 135. Last but not least, whatever the saying is, CCJ. It's late, all right? It's 9:36. Bear with me. I'm sure you're watching this even later if you're in the late night crew. And by the way, the keyword, if you didn't know, was night owl. I'm sure you see that a ton in the comments. That's why. All right, so CCJ, last trade idea, and then we're out of here. What do we see, right? 100% retracement, dead cat bounce, lower high, equal lows. Again, if this breaks, we're expecting repair of this area to come back down into this prior support around 1845. This zone is in between 2045 and 20 even. Again, this H pattern, lower high, equal lows, is setting up a breakdown for a short trade inside of CCJ. That's all I've got for you on today's session. If you enjoyed the video or learned anything new today, let me know in the comments section or by giving the video a thumbs up. Don't forget that the Friday video will be coming out as scheduled. That's the crypto video. That one never really gets much love. I'm sure no one's really interested, so we're just going to wrap it up at that. All right, late night video. Thanks for tuning in. Hope you have a good one. Stay green out there.